Welcome back to this week's edition of the Risk Spotlight Operational Risk News Update. My name is Emily Jones, and today I'll bring you essential updates and insights from the world of operational risk. All information is sourced from the Risk Spotlight Portal, the premier forward-looking service for operational risk content. Let's get started. First up, let's talk about synthetic identity fraud, a rising challenge for lenders in the United States. According to TransUnion's latest report, synthetic identities among attempted accounts opened by U.S. lenders reached an all-time high in the first half of 2024. Synthetic identity fraud involves combining real personal information, like social security numbers, with fabricated details to create a false identity that passes verification checks. This is increasingly impacting sectors like auto loans, bank credit cards, retail credit cards, and unsecured personal loans. Interestingly, auto loans have become the prime target for fraudsters, doubling in balances compared to the bank card sector. The exposure to synthetic identities for auto loans has reached a staggering $3.2 billion, which is 7% higher than last year. The rise in fraudulent activity could lead to an increase in charge-offs, presenting a significant risk for lenders. The report also mentions an uptick in a related scam called credit washing, where fraudsters file false identity fraud claims to wipe negative records from credit histories. This worrying trend suggests that lenders need to bolster their detection and resilience mechanisms to counteract synthetic identity and credit washing fraud. Moving on to the topic of cybersecurity, the Eurosystem has revised its cyber resilience strategy to address the evolving threat landscape. This revision takes into account geopolitical tensions and technological innovations like artificial intelligence and quantum computing. A notable update is the incorporation of new entities under the PISA framework, encouraging non-financial market infrastructures to periodically assess and enhance their resilience. The strategy also aligns with the EU Digital Operational Resilience Act to ensure that central securities depositories and other financial institutions remain well prepared. This harmonization effort reflects the growing need for financial infrastructures across the EU to adapt to new regulations and keep pace with evolving cyber threats. While we're on the topic of resilience, the recent Crowdstrike incident has underlined the criticality of operational resilience for financial firms. The UK Financial Conduct Authority, or FCA, highlighted that third-party related issues were the leading cause of operational disruptions reported between 2022 and 2023. Following the disruption caused by the Crowdstrike Falcon content update, Microsoft users faced significant crashes. The FCA encouraged all firms, whether directly affected or not, to use this as a learning opportunity, stressing the importance of following operational resilience rules. Firms that had already mapped their key business services and defined communication strategies managed to minimize impacts quickly, showcasing the value of preparedness and prioritizing essential services during incidents. Now let's shift gears and discuss online financial scams, an area that has sparked quite a debate between banks and the federal government in the United States. The American Bankers Association, led by CEO Rob Nichols, is calling for federal action on online financial fraud, which led to a massive $10 billion in consumer losses last year. Banks and the federal government are pointing fingers at each other to solve this issue. While the government insists banks should take more responsibility and consistently compensate victims, banks are urging the government to focus on prevention measures. This ongoing standoff underlines how crucial it is for both parties to collaborate. Recent investigations by the Consumer Financial Protection Bureau into large banks like J.P. Morgan, Bank of America, and Wells Fargo, which own the payment service Zelle, revealed declining rates of compensation for disputed transactions, underscoring the complexities of handling consumer fraud. A concerted, unified effort seems to be the only way forward to mitigate this ongoing challenge. Speaking of data breaches, ExtraHop released an insightful report on the cost of data breaches for publicly traded companies. Their analysis reveals that breaches cost organizations an average of $677 million, significantly higher than previous estimates. The report highlights that affected companies saw their stock prices decline by an average of 7% in the month following a breach, emphasizing the serious financial repercussions. One particularly notable breach cost an organization around $2.8 billion, covering lost revenue, business disruptions, and incident response. This serves as a stark reminder for organizations to reassess their cyber risk and resilience strategies, ensuring that they are prepared to swiftly detect and mitigate potential breaches. On a related note, IBM's 2024 Cost of a Data Breach report draws attention to the widening cybersecurity skills gap, which is exacerbating the financial impact of breaches. The shortage of skilled professionals in cloud security, threat intelligence, and incident response has led to a significant rise in breach costs, adding an average of $1.76 million per breach. As businesses migrate more data to the cloud, expertise in these areas is in high demand. The report emphasizes that organizations utilizing AI extensively in their prevention workflows have been able to save up to $2.2 million in breach costs. This suggests that integrating AI, expanding training, and encouraging certifications could be effective ways for organizations to overcome the skills shortage and enhance their resilience against future threats. And lastly, we turn to a different form of digital threat, the resurgence of Android malware. Researchers recently uncovered a new version of the well-known FakeCall malware. This malware, which utilizes voice phishing techniques, is designed to take near-complete control of mobile devices, intercepting calls, capturing personal information, and even redirecting calls made to legitimate financial institutions to fraudulent numbers. FakeCall has primarily targeted mobile users in South Korea, but its sophisticated capabilities make it a significant concern globally. The emergence of these advanced techniques, despite widespread caller identification apps, suggests a constant game of cat and mouse between attackers and security defenders. Now let's turn to key operational risk loss events reported last week. The first update is about a former TD Bank employee, Daria Sewell, who faces criminal charges in the U.S. for allegedly stealing and distributing customer data while working in the bank's anti-money laundering department. Sewell is accused of possessing and sharing personal information from 255 checks and nearly 70 customers' details on Telegram, instructing others to commit check fraud and split the profits. This case is part of a broader investigation into a $500,000 check fraud scheme involving 5 other individuals. The incident adds to TD Bank's ongoing challenges, following its recent $3 billion settlement with U.S. regulators over anti-money laundering failures. The next update is about J.P. Morgan Chase agreeing to pay $151 million to settle 5 enforcement actions brought by the U.S. Securities and Exchange Commission, SEC. The SEC charged 2 J.P. Morgan affiliates, J.P. Morgan Securities and J.P. Morgan Investment Management, with multiple violations across several business lines. These included misleading disclosures to investors, breaches of fiduciary duty, prohibited transactions, and failures to make recommendations in clients' best interests. The next update is about how British banking giant Barclays was pressured to divest from the Israeli arms firm Elbit Systems. Despite Barclays' denial of direct investment, activist group Palestine Action claimed victory after the bank reportedly sold all its shares, valued at over $3.4 million, in Elbit Systems. This move followed a persistent campaign involving over 50 direct actions against Barclays, including protests and property damage, aimed at highlighting Elbit's role in supplying military equipment to Israel. While Barclays maintains that it held shares only due to client transactions, the activist pressure has been credited with influencing this divestment decision. The next update is about Crédit Agricole and Credit Suisse losing their appeals against EU cartel fines. The General Court of the European Union upheld the multi-million euro fines imposed in 2021 for their participation in a bond trading cartel. Credit Suisse was fined €11.9 million and Crédit Agricole $3.9 million for colluding in the European market for US dollar-denominated SSA bonds. The court confirmed the infringement findings and maintained the original fines. That concludes this week's operational risk updates. For more on these topics and additional insights, visit the RiskSpotlight Portal. If you're a subscriber, log in or go to riskspotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.